Well, moving on now, Japan has unveiled one of its most ambitious economic plans in decades. Prime Minister Sanae Takaichi wants to invest 370 trillion yen, or about $2.5 trillion, by 2040 across 17 strategic sectors. Now, this includes artificial intelligence, semiconductors, biotechnology, defense, energy, and shipbuilding. The government says the investment will boost productivity, help Japan remain competitive in the AI race, and reduce its dependence on China. Now, the blueprint also aims to lift Japan's long-term economic growth rate above 1%, a level the country has struggled to sustain after decades of slow growth, deflation, and an aging population. But while the plan promises a major industrial revival, investors are increasingly questioning how such a massive spending program will be financed. Now, financial markets are drawing comparisons between Sanae Takaichi's spending plans and former UK Prime Minister Liz Truss's 2022 mini-budget. The concern is not the size of the investment alone, but the absence of a detailed funding strategy. Japan already carries the highest public debt among developed economies, with debt equal to about 230% of GDP, even after improving from nearly 260% in 2020. Since the proposals were announced, Japanese government bond yields have climbed to their highest level in nearly 3 decades, while the yen is hovering close to a 4-decade low. Investors fear that higher borrowing, combined with rising inflation and growing debt servicing costs, could undermine confidence in Japan's public finances if the government fails to present a credible financing plan. Now, despite the concerns, Japan's situation differs significantly from the UK. Most of Japan's government debt is held domestically by its central bank, pension funds, banks and insurance companies, making the country less vulnerable to sudden capital flight. The Bank of Japan also continues to play a major role in supporting the bond market, although it has raised its policy rate to 1%, the highest level in 31 years. If Takaichi's strategy succeeds, it could strengthen Japan's leadership in advanced manufacturing, AI, and semiconductor production. However, failure to reassess or reassure investors could push borrowing costs even higher, weakening the yen further and increase inflation more. The outcome will matter well beyond Japan, influencing global bond markets, competition, international supply chains, and investment flows across Asia, especially India.